Jonathan, I'm going to start off by discussing China. What really is happening and what's the call really on whether or not one can see stability emerging in not just the Chinese economy, but equities as well?
Well, I think the bottom line is that the economy is quite weak here. We have a proprietary macro indicator which suggests that in July the economy took another move downwards. So we have metrics like auto sales running at -7% year on year, exports running at -8% year on year. And I think what you're seeing is a policy response that's different from last time. So it's more gradual on the monetary and fiscal side, but now we have the exchange rate dimension that's been brought in. We're cautiously optimistic by the fourth quarter that China's growth may be picking up a little bit, but it's certainly too soon to buy the equity market in our view.
Do you think markets are underestimating the concerns which currently the Chinese government has managed to sort of conceal, which is the issue of shadow banking and what is really happening to the trade deficit?
Well, they're running an overall current account surplus still. Their reserve position has come down somewhat, but it's still got the best reserve coverage of imports of any country in emerging markets. So this currency move is very much of their own making, their own choice. On shadow banking and bank NPLs, we have estimates out there that are lower than some on the street. They've done actually a reasonably good job of cleaning up some of the weaker parts of the banking system. So we're not as bearish as many on the street on the Chinese banks.
Jonathan, but what really happens to the currency devaluation? It seemed like last time around when PBOC devalued the currency by 1.6%, that was just one of the tools in their kitty. Could we see a series of such moves come in, and could we see further devaluation of the Chinese currency coming in?
Well, we think they're moving to a nominal effective exchange rate targeting regime. They genuinely will increase flexibility, and there's been a loss of competitiveness against the euro and the yen. And so with our forecasts for the major currencies, we plug those in, we get a view that the renminbi will be at 6.6 to the dollar by the end of this year and 6.9 by the end of next year. But, I would contrast that moves against the dollar are much less than we're getting elsewhere in emerging markets already.
Look at the MSCI index, so MSCI Emerging Market Index, which is widely tracked by global fund managers. That index is sitting at a multi-year low. What does that indicate? Do you think the outlook towards emerging markets is still bearish and it will remain bearish in the foreseeable future?
Yeah, we wrote a note a couple of weeks ago pointing out that emerging markets are now in a 4-year earnings recession. Every one of the largest countries, the 12 largest countries in EM, is in an earnings recession, and all of the sectors. So we're in a very difficult place right now, and we have had EM for a long time as our least preferred region in global equities. So this is not a big surprise to us.
I want to talk about your reading from the Fed minutes overnight, because again, the governors, it seems, got a close eye on China, and that is a situation that they too are monitoring. What is the sense that you're getting about the commentary? It doesn't seem like it's going to be a September lift-off by the Fed.
Yeah, we didn't have a September view. Our view for a long time has been December. They have many things that they need to consider, but ultimately the reason that they will hike rates is the US economy is strong and the labor market is doing very well in the United States. And so that's why they'll be keen, having kept rates at zero for so long, to raise them. But we think that process will be in December, and it will go quite gradually thereafter.
Jonathan, I distinctly remember as a firm, you were bullish on India about 6-7 weeks ago when the world was chasing Chinese stocks. Morgan Stanley went on record and they said, look, China, we like China, but we prefer India. Is that trade still open, or you think Indian markets now are priced to perfection?
So we downgraded China in early May, and we upgraded India to being our largest overweight. It's still our largest overweight, and India has significantly outperformed the rest of emerging markets in the last few months. And I think we have to ask why, and I think it's got a lot to do with the fact that growth is picking up in India. Inflation is actually coming under control. Bond yields are falling, which is almost unique in the emerging markets complex right now, and we can still be talking about interest rate cuts, which you're not in much of the emerging world. So India's story is a very strong one right now on a relative basis. It benefits hugely from lower oil prices, lower food prices, and other imported goods prices. And again, that's very different from what we're seeing in, for example, the whole of Latin America.
Jonathan, Indian bears would argue that India, for a change, has become a great macro story, but the micros are not in place. And when I say micro, earnings are not there, top line growth is still sluggish. The earnings season just got concluded about a week ago, and somehow the earnings season is not inspiring a whole deal of confidence.
Yeah, India has been in an earnings recession, but as the macro is turning now, we should see that reflected in corporate earnings going forward. So we're recommending buying some of the cyclicals, including consumer cyclicals as well as industrials, which is different from what we're saying in the rest of emerging markets, where the inflection point in growth is still very much to the downside, including in China.
Jonathan, so tell us a little bit more about your India exposure. What sectors do you see holding out in the current state of economy, considering it's been a washout parliament session as well? A lot of market men were hopeful that the GST, that's the goods and services tax, is going to finally see the light of the day this time around, but that hasn't happened. Which sectors of the economy do you see progressing in the months to come?
So I just mentioned the cyclicals, both the consumer cyclicals and the industrial cyclicals. We also like the banks, the private banks more than the public banks, but even in the public banks, you're getting some reform initiative there. Where we're less bullish than on those sectors would be on the pharma sector, on the information technology sector. They're kind of solid holds, but they don't have particularly dramatic catalysts at the moment.
Jonathan, really appreciate your time. Glad you could join us.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.